Never been.
Test 1, 2, 3.
It's got blown up.
And by the way, I will always be here by 8, but I will be here at 8. That's my love. You're like, I waited in the parking lot at 7:50. I just go up. I know it says be here 15 minutes. No, please don't. I'm not that. I always put that by no. I know. I don't know how you get here on time. My husband. Oh, because he would. Kyle, Bonnie said she can't hear anything.
Recording in progress.
Okay. Okay. Good morning, everyone. Good morning, everyone. Welcome to the Real Assets Committee meeting, first one of the year. This time around, can we go ahead and get roll?
Yes. 1 second. Thank you, Mr. Jones. This meeting is being conducted as a virtual and in-person meeting, so I will do a roll call of trustees to confirm attendance. Mr. Jones?
Aye. Or here.
Miss Langton? Here. Mr. Root?
Here.
Thank you. Miss Martin? Here. Okay. Miss Ginsburg? Here. Miss Me? She's here. I saw her. Mr. Green?
She in transit.
And Miss Martinez. Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, and we have Mr. Samuel Blowen from Alborn Partners. We may begin with the agenda.
Okay. Yeah. Do we need to do the procedure?
No.
Okay. Super. Okay. All right. So then, as it relates to next part of the business is approval of the minutes. Do we have any amendments to the December meeting that we last had at all to it? If not, can I have a motion to approve?
Hello.
Gotcha. And then do I have a second? Thank you.
Okay. Mr. Jones?
Aye.
Miss Langton?
Yes.
Mr. Rue?
Yes.
Okay, and Miss Martin?
Aye.
Okay, the motion passes unanimously.
Gotcha. And then public comment. I can't imagine how we wouldn't have some public comment given how juicy our agendas are, but do we have any public comment?
No public comment.
No. Okay. So one of the best kept secrets in the LACERA committee, so I hope. And then the next one will be our report, which we're excited about. I was hoping to see Mark, but I guess assume Mark is out and about, but it's a pleasure to meet you, Sam. Jude, do you want to go ahead and introduce our partners there? And then
well, actually, I'm going to hand the presentation off to my colleague, Tara Eliza. She'll be introducing the topic for us, and then we'll go from there.
Awesome. Welcome, Tara.
Thanks, Jude. Good morning, Chair Jones and trustees. Today for the committee, we have an educational session on real assets. It will give an overview of the overall market and space in general, and we'll get into specifics of LACERA portfolio. But for context, it will cover the LACERA categories of infrastructure, which has a 4% target allocation within the total fund and sits at $3.8 billion currently. It will also cover natural resources, which has a 3% allocation target to the total fund and sits at 2.4 billion. And TIPS, or Treasury Inflation Protected Securities, which also has a 3% allocation target and is at 2.4 billion. So Allborn is our consultant that covers these categories for the board, and they will give the presentation today. I'm happy to have Samuel Bluen here today to present. And Sam will touch on topics such as asset class characteristics, portfolio objectives, performance drivers and targets, and also some risk considerations. And so with that, I'll now turn it over to Sam and to begin. Thank you.
Welcome, Sam.
Thank you very much, and thank you, Tara. So good morning. It's good to be with you this morning. As Tara mentioned, my name is Sam Bluen. I'm a senior portfolio analyst at Allborn, and I specialize in real assets. So as she mentioned, for today, we're going to go through an introduction to real assets. So we're going to start by defining what we mean when we refer to real assets, the investable universe. We'll get into some of those characteristics that make real assets unique, and then we'll tie it into how institutions think about real assets in the context of their portfolios. Excellent. So with that in mind, we're going to start with the definition. And I apologize for reading from the screen. I'm just going to do it on this one slide. But we define real assets as an asset that is intrinsically valued based on its utility. It is tangible, homogeneously produced, and consumed. And the valuation drivers include characteristics closely aligned to inflation and economic variables tied to supply and demand. Now, I don't expect you to memorize that definition by any means, but there are 3 key points that I want you to take away as it relates to the definition here. So the key points are, it's tangible. These are physical investments that you can go and touch. It's consumed. Real assets is consumed. And it's consumed as an input into the economy. And third point is it's aligned to inflation. So because it is an input into the economy, oftentimes its price can be the cause of inflation. And we're going to get into inflation more throughout the presentation. But again, keep in mind those 3 things: tangible, consumed, aligned to inflation. Now, in terms of the investable universe, we kind of have to come back to that definition and how real assets is unique because it sits in its own investable space. Yes, real assets will share characteristics with other investments, such as real estate. Real estate is also tangible. You can touch it. But real estate is not consumed in the same way that real assets is. And thus, real estate will not have the same inflation characteristics as real assets. Real assets will also have a duration component associated with it, which means it can be priced similarly to a bond. But credit is ultimately not tangible, and thus it behaves very differently from real assets. And finally, investments in real assets can actually drive improvements to the value via operational enhancements in similar ways to how private equity can buy a company, improve its operations, and sell it at a higher value. But what you'll find out later, what we'll walk through later, is the key differences to drive that performance for real assets specifically. And ultimately, you'll see how it behaves very differently from private equity in the context of a portfolio. Now, the second point that I want to make about this slide is that you can kind of divide real assets into kind of 2 categories. Yes, we'll get into the difference between the public markets and the private markets. But in terms of the assets themselves, I want you to think about real assets being one portion of the real assets universe being man-made real assets, so infrastructure, and those real assets that are found in nature, so natural resources. Now, some of those categories for natural resources will be pretty self-explanatory, but we'll kind of dive into each one in the next slide. But I recognize that infrastructure, they may not be as intuitive. And so what you have on here is the risk spectrum as it relates to infrastructure assets. So when you hear the term core infrastructure, I want you to think about the most de-risked, monopolistic assets you can think of. And when you hear the term opportunistic, I want you to think of the riskiest, maybe less monopolistic investments. But diving into the individual sectors and the subsectors a little bit deeper here.
Hey, Sam, real quick, could you just give us an example? You went from core to opportunistic. Core would be what type of infrastructure? Opportunistic would be, I don't know what, SMR, data center type things, but can you just kind of give us a sense of, beyond the name, end to end, what type of asset you're talking about?
Sure, absolutely. So core, again, coming back to that term of monopolistic, I want you to think of maybe the Golden Gate Bridge, right? You're not going to put a second bridge right next to it. It's there. It's a core piece of moving people from one part of San Francisco to the next. Okay, very de-risked. On the other hand, you may have a power plant, maybe a solar farm that's in development. Okay, so think there may be multiple sources of power feeding into the grid. This one may be have a lot of greenfield risk associated with it, meaning it's being built out, and thus it might have a higher risk profile. But maybe one of the key points to think about when it comes to infrastructure, and you can actually see it on this slide as well, is that there are different sectors. And so you can think of, when you think of infrastructure, you can think of your bridges, your toll roads, your airports, your power plants, your data centers. But these sectors are independent of the risk profile. So you can have a tower, for instance, or a data center that is very core-like in nature, and you can have a different data center that is very opportunistic-like in nature. So they're not necessarily the same, they are slightly different.
Thank you.
And going further into some of those natural resources here, when you think of agriculture investments, I want you to think about your row crops, also known as annual crops. So things like soybeans, wheat, corn. You also have your perennials or your permanent crops, such as investments in almonds, in orange trees, and even in wine grapes. In terms of energy, you can kind of divide the energy universe into kind of two separate camps. So you've got traditional energy sources, and you have your energy transition sources. So think those solar farms, those wind farms. In terms of mining, you can have mines that extract metals such as copper or aluminum, and you can have mines that focus on rare earths like lithium ion. Infrastructure we just sort of covered, but I'll jump to timber next. In timber, you can kind of divide the universe into two camps: your hardwoods, such as your redwood, and your softwoods, such as your pine. And how those woods are used as an input into the economy will slightly vary. So they'll have slightly different risk and return characteristics, but ultimately they fit within the context of timber. Now, you also have investments in liquid real assets, and these can kind of be divided into three different camps. You have commodities, which you can get access to via your passive indices, or even investments in hedge funds that may trade commodities on a regular basis. You also have resource-related securities. So these are public equities, and my understanding is that you all have some investments in DWS's public security vehicles. Those would sit cleanly into this camp. And then you have your TIPS, so your Treasury inflation protected securities. These are essentially government bonds that adjust their value based off of inflation. But regardless of the liquidity profile, the benefits to investing in real assets are largely the same. And we'll zoom in on those benefits on the next slide. But what I do want you to understand about the differences here are that there are pros and cons to investing in the liquid versus the illiquid asset classes. So on the one hand, you have liquid real assets. The pros there are that you can get immediate exposure to the physical assets that you're looking for. So you can get into them very, very quickly. You can also get out of them quite quickly, right? So if you need that capital back, you can easily access it. Now, the problem with that, or one of the cons, I should say, with that, is that it leaves those investments open to more systematic risk and thus higher volatility. On the other hand, you have the illiquid real assets. So it takes a little longer to get the exposure you're looking for. It takes even longer if you need to get that liquidity back. But the market value is going to be more stable over time. And in fact, it may even outperform, as you may be able to capture an illiquidity premium. So again, liquid, think easy access, but maybe more volatility. Illiquid, think harder to access, but more stable. But regardless, again, of whether you invest via the liquid or the illiquid, the benefits of investing in real assets are largely the same. So these investments are primarily achieving a stable cash flow. They'll have some inflation linkage to them, and they'll have low correlation to other asset classes. So let's take an example here. Let's think of a solar farm, for instance. Well, solar farm exists to produce electricity and to sell it onto the grid. Now, in doing so, it's going to have a PPA associated with it, which we call which stands for Power Purchase Agreement, with a counterparty. And so that power purchase agreement is going to create the stable cash flows from the production of the electricity to selling it onto the grid. Now, included in that PPA will likely be an inflation escalator, so that if costs to operate and maintain the solar farm increase, then the owner of that solar farm can pass those costs on to the counterparty, thus giving it inflation linkage and protection against rising costs. Now, thirdly, regardless of what happens in the equity markets, so regardless of the volatility in the S&P 500 or the NASDAQ index, the value associated with that solar farm will be linked to its production and maybe even inflation. So its performance is not going to be tied to other investments that you may have, thus giving it low correlation to those other investments. Now, what's interesting about this is that these benefits may kind of appeal to you, right? You can see why institutions are interested in real assets for these reasons. But when institutions build real asset portfolios, it's important to keep in mind that they tend to build it to achieve very specific objectives. And oftentimes those objectives are tied directly to some of the unique characteristics of an institution. Now, what you have on the screen here are 4 of the most common portfolio objectives that we see defined in an institution's strategic asset allocation or in their investment policy statement.
So Sam, question for you here. So as I was going through this last night, the only thing that I would have appreciated maybe in a subsequent graph was when you look at the 4 purposes there, which ones are the more heavily, is it more weighted towards diversification versus GDP sensitivity or what have you? Do you have a commentary? Can you kind of give us a sense of the distribution of that?
Yeah, so that's a great point, right? And these 4 characteristics are not necessarily the 4 that everybody focuses on.
Or all equal, right?
Correct, yeah. Correct. Typically it's 2 or 3, and each one will be weighted slightly differently to your point. Inflation protection tends to be the number 1 focus by far out of these various categories. Number 2 tends to be diversification. Maybe third would be income generation. It's more important to some institutions than others, and that will largely depend on things like funded status, for instance. And GDP sensitivity tends to be the least common, but we do see it apply in different ways. And what we mean when we say GDP sensitivity here is that institutions may be looking to capture additional enhanced returns via more GDP exposure, or they may actually be looking to reduce GDP exposure from the rest of their portfolio.
Sam, another question for you. I know that Canadian plans and those European plans that have a tendency to be more than 100% funded have a higher concentration of real assets there. I imagine in that instance, that's primarily an inflation protection related one. We're around 81, 82% funded, kind of progressing towards there. Should we, as a board, expect to see an increasing allocation or a change from maybe inflation protection or diversification to something else? Or I'm just curious, how would you think strategically a fund of our size and funded level would be kind of progressing in this kind of arrangement?
So I'll speak to what we typically see in terms of other institutions around that 80, 90% funded range. They tend to be primarily focused on that inflation protection and the diversification component. Once they get closer to that 100% status, they may shift more into income generation, and that being uncorrelated income generation to things like private credit and real estate.
Okay.
Another important thing, though, to notice about these objectives is what's not on here, right? So what you don't see on here are institutions building real asset portfolios to try to outperform things like venture capital or private equity or even public equity. It tends to be very specific towards that more downside protected lens. And so if you think of to your question about being 80% funded, let's think about a pension that's only 40% funded. Well, they may not be focused on real assets at all.
Yeah.
And if they are, it may not even, if they invest in real assets, it may not even be within the context of a dedicated real assets program. But what also is interesting about institutions who do invest in real assets is that they tend, because they may have different unique characteristics at a policy level, they may each, no two real asset portfolios look alike. And so what you have on the screen here are the various asset classes and how those asset classes behave based on the different market sensitivities or how they might differ in terms of their investment characteristics. So I'm going to take an example here. I want you to look at energy versus core infrastructure. Well, both of these have a high degree of income generation, so they're high yielding. They also have a high degree of inflation sensitivity, which means they will have a high degree of inflation protection should inflation rise. But look at the GDP sensitivity to each. Energy is high, core is low. So if I'm an institution and I'm looking for income generation, inflation sensitivity, but I actually want to reduce some of my GDP exposure, I may be more focused on core infrastructure than energy. But now I'd like to draw your attention to the chart at the bottom. So the chart at the bottom shows the expected kind of returns for each one of these categories. And so what you'll notice on energy is that it's a higher return seeking and wider dispersion of outcomes. Then core infrastructure, which is lower returning seeking, but also lower risk, lower dispersion. So it's one thing to want income generation and inflation sensitivity. But if I have a minimum return requirement of 16%, well, now all of a sudden we can't be investing in core. We have to be investing more into energy.
Hold on, Sam. Trustee Me, I have a question now.
slides. Do you mind to explain the leverage? What do you mean leverage here?
Certainly. So this is the tendency of the asset class to use leverage in order to enhance or juice the returns. Now, what is interesting about this is natural resources is quite low, what we see, right? And it's actually more of a factor of these managers who invest in these strategies actually not being able to get leverage. If they could get leverage, they probably would. But in general, they have a harder time getting leverage.
I thought agriculture is really supported by government. They have a lot of loans, everything from government, not the private sector. So they're not able to get those loans, those credit.
So think of this as the investment firm, the investment fund trying to gain leverage in to enhance the investments that they have, not necessarily like a farmer going out to get a loan.
Got it.
Yeah.
Thank you.
But it's also worth pointing out the leverage as it relates to infrastructure. Because if you have other investments in real estate, this may actually look kind of opposite to you. In real estate, core tends to have lower leverage and opportunistic tends to have higher. Well, it's actually the exact opposite in infrastructure. These core assets will have more leverage to them because they're very de-risked compared to the opportunistic. So I'm going to switch gears just a little bit here and kind of dive in a little bit more in terms of some of those qualities of real assets that make it unique from a return perspective. So every real asset investment has these three characteristics to it. It's going to have a base asset, which is tangible. It's going to have an underlying commodity driver, which is going to be based off of supply and demand and maybe even cyclical in nature. And it's going to have some operational levers to it. So things that investment firms can do to add additional value. Now, when we think about the base asset and the commodity driver as a portion of the return, we consider this to be beta. And when I refer to beta here, I'm referring to the return that the market is going to give us. It's largely uncontrollable versus the operational levers, which are going to be alpha. So something that they can actually do. So I'd like to walk through an example here, and I'd like everybody to think about an airport and how these three characteristics relate to an airport. So an airport is tangible, has a base asset, right? It has runways, it has terminals. You can walk on them, you can touch them. But what is the commodity driver of an airport? Well, think about what the socioeconomic purpose of an airport is. What is it meant to move through it on a regular basis? And the answer is people, right? At the end of the day, the purpose of an airport is to move people around the world. Now, when we think about that base asset and that commodity driver, they're largely uncontrollable, right? If I buy an airport in one region and nobody wants to fly out of it, I can't exactly pick it up and move it to a different region. It's stuck. I also can't control for the macroeconomic factors that lead to more people flying. But what can I control in this investment? Well, I can control how quickly those people move through security and thus how much time they might have to spend money on retail. I can also control the type of retail that I have in my airport to, sync up with the type of people who travel through my airport. And I can also control the different regions that my airport ultimately connects to fit the type of people that live in my area. And when we put this all together, you can get a return profile out of an airport. Now, when we see these three characteristics play out in terms of their performance and their characteristics versus the market, we see some pretty interesting things.
Sam, hold on real quick, as I was noodling. Pardon me. So then what you're saying on the previous slide is that while, particularly in alternatives, manager selection is extremely important, expertise. Are you saying it's especially important in real assets from an alpha seeking perspective, or about the same as other alternative classes or less?
I'd say about the same. And the reason being is that in real assets, there is a heavy beta component to it, right? So a lot of that return is still going to be coming from a market factor. But having good managers who understand these assets can lead to additional performance.
Okay.
Now, I say the same and not more or less, because when you talk about venture capital and private equity, they're going to have a higher dispersion of outcomes with their performance. So their alpha may be very, very high, whereas in real assets, alpha may be really, really tight.
Okay.
But you can still determine, you can still see in the data better managers who can slightly outperform the median on a regular basis.
Okay, thank you. Yeah.
And so what you have on the screen here is a Dimson beta analysis. And what I want you to think about when we say Dimson beta is an investment's sensitivity to a market factor. In this case, the MSCI ACWI, or a public equity index. And so in here, I want you to think that the further to the right you are in this chart, so the higher your Dimson beta, the more sensitive that investment is. And now the categories on here are not specific to LACERA. These are Allborn's indices for private markets. But what you can see in this is that categories like LBO growth and venture capital have a much higher sensitivity to public equities, which is what you would expect. So if the MSCI ACWI becomes more volatile, we can expect LBO growth and venture capital to become more volatile with it. But look at where real assets sit. So infrastructure and natural resources. Well, infrastructure has a very low Dimson beta, and natural resources is even negative. And so what this means is that regardless of if the MSCI ACWI gets volatile, it will not necessarily cause infrastructure and natural resources to become volatile with it. And so when you think about the context of your portfolio here, you can see the benefits that real assets can bring, true diversification benefits to other investments that you may have.
Absolutely. Yes, Trustee.
Like if you can slide back, for this group benefit, like could you expand on the negative beta? Like is it going opposite from the market direction?
That's right. That's right. So if you were to have a negative beta of 1, then it would move in the very opposite nature to that investment.
Inverse.
So natural resources is not quite that far, but it is negative, meaning it could potentially move in the opposite direction compared to public equities. Now, unfortunately, no investment is without its own set of risks. And as you can imagine, real assets will have its own unique set of risks to it. So we'll have certain market risks, right? What is the risk that inflation stays very low for long periods of time? It'll have asset level risk. So think about my example with the solar farm. What happens if the counterparty goes bankrupt and can't pay? It may even have operational risks. So what happens if I mismanage an asset? Or what happens if I fail to meet a certain environmental regulation? And all of a sudden I'm left with a stranded asset that I cannot sell. Now, it's important to understand that in the context of these risks, ultimately, through due diligence and understanding of the asset class, the managers you invest with can mitigate these risks. But understanding them is obviously important. final topic I'd like to touch on today are these other policy considerations. Now, we've identified kind of 10 common ones that we see addressed at the board level. So as the board, you are ultimately responsible for understanding these other policy characteristics and how they may impact your team's ability to invest in real assets. And so let's talk through a couple of them. So we have liquidity requirements, for instance. At the end of the day, you're a pension, you need to make liability payments, and thus you need a certain liquidity profile. Well, having different liquidity profile can obviously impact the types of investments you make in real assets. You may even have geographic limitations. So mining, for instance, is an asset class that can have a higher degree of emerging market exposure. Well, if you have certain restrictions against those emerging markets, it may impact the types of mining assets that you can invest in. You may even have that minimum return requirement. So if you have a minimum return requirement, it could impact your ability to invest in real assets to begin with, or the various asset mix that you may make. But ultimately, it is up to the board to ensure that these policy considerations are taken into account and put into policy via your strategic asset allocation or your investment policy statement. And boards like you will also be considering these things as a part of their program. Now, this is our final slide, and I just kind of like to tie everything kind of back together. So we have our definition of real assets. It's tangible, consumed, aligned to inflation. Those characteristics allow real assets to be its own unique investment universe. Yes, it will have some characteristics similar to private equity, may have some characteristics similar to real estate, but ultimately it can stand on its own. Now, I want you to think about this in terms of the total pie of your portfolio. At the core of that is policy, and policy is ultimately driving the ship here. Policy will determine whether or not real assets is even a fit to begin with. But once it's determined, then it's up to the CIO and the investment staff to go out and source the appropriate strategic and even tactical mix to align with those policy objectives. I'll pause there. We can open it up to some questions if we have time.
Thank you, Sam. I appreciate that. We've got plenty of time thus far. Any other questions or thoughts from the board? Go ahead, Trustee. Mm-hmm.
I do appreciate the presentation very much. I like to understand the infrastructure piece of it a little bit more, just because of where I'm coming from. I'm a civil engineer working for Department of Public Works, Department for Infrastructure. So my understanding is that infrastructure for government-owned and operated infrastructure, we're not investing in those, right? There's no money there. So what we invest in, are they like a public-private partnership infrastructure, or what's the difference there? Like there's a lot of infrastructure is government owned, operated and built, right? So those projects that my department's doing, we're not making money. We paving the road, we're doing the traffic signal. None of that generate any income, right? So, but I can see some of the project is a private-public partnership, like the high-speed rail from Rancho Cucamonga to Vegas, right? So those would generate revenue. So when we talk about infrastructure here, are we talking about the kind of projects that is not government-owned or operated, and then the type that can generate us revenue?
Yes, to some degree, right? And that's typical for the United States, right? That those privately owned infrastructure projects, or those infrastructure projects which are done via P3s, are kind of the investable universe. But in other regions, parts of the world, those P3s might be more prevalent. So in Europe, for instance, there are more investments in those public-private partnerships than what you may find in the United States.
Maybe that's the reason why in other part of the world they build faster than we do. So the other question is, we do have this generational grant in federal level in the US, right? The BIL grant, IIJ Act is like $1 trillion for the next 10 years that we're going to upgrade our infrastructure in the United States. Is that something that presenting some opportunity for us, like more projects maybe for us to invest in to profit from? What do you think of that opportunity?
So maybe I'll make my comment a little bit more broadly. There is an aging infrastructure across the world, really, particularly in the United States. And so there has been a lot more focus on investing in that aging infrastructure to improve it. And so a lot of capital and resources is going into these projects, which has really expanded the opportunity set. Infrastructure as an investment actually really wasn't that prominent until about 2010 in the United States. The Canadian pensions were investing in it much earlier, but in terms of US capital, not really until about 2010 did that really start. And so this universe has really expanded over that time and continues to expand because of the growing need for the country to be able to build upon that infrastructure.
Thank you. Maybe this next question. I'm sorry.
No, go ahead. We're here.
I can
We're here.
go to Ju. I'm just trying to learn more about this. So this question might go to Ju. In that sense, since the United States, most infrastructure, unlike Europe, right, is 3P. Here, a lot of it dominated by government. Does it mean that in our portfolio, do we have more infrastructure outside this country or more here?
Yeah.
Give me 1 second, Trustee Me, and I'll pull up the geography stats for you.
Yeah, so within US and Canada, we have about 40%, and we do have a large allocation to Europe, which is around also 40%. It's a big market for infrastructure. And so we do look to diversify. We do have other undeveloped countries that we invest in as well. But the majority of the infrastructure portfolio is in Europe and US, Canada.
Got it. Thank you.
Yeah.
So, yeah.
Any other questions for Sam or Tara? No, thank you. Outstanding. Appreciate the time there. Congratulations on the 30 years as well for Alburn there. So the
Thank you very much.
Robust Travel reference, one of my favorite books. Okay, with that being said, then we'll move down the agenda. Thank you very much again to Tara. Did you have anything else that you wanted to, as a part of the presentation? I don't want to make sure I'm cutting you off artificially.
No, that's it. Thank you so much, Sam.
All right, thank you. So items for staff review, anything, right? Items for future agendas, and then for good of the order. So let me just go left to right. Trustee Rue, did you have anything? I know you're remote. Did you have anything you wanted to comment on otherwise?
No, I'm good. Thank you.
Okay, gotcha. Trustee Me, anything? Go to the order. No, nothing on my part either. So then I will, presumably Jason will come in and we'll start right at 9. Otherwise, all right, adjourned.
Recording stopped.